Now let's look a little bit more closely at the Federal Reserve now that we know what quantitative easing will really look like. We've got a taking stock think tank to tell us all about it. Dino Kos, Managing Director of Portales Partners. He spent 2 decades at the New York Federal Reserve. For fixed income reaction, we've got the Chief Investment Officer of Commonwealth Asset Management. We have Henley Smith. And also with us, Peter Coy, the economics editor for Bloomberg Businessweek. The latest issue of the magazine out on newsstands now. And he's got a fine tie collection, too. We're going to get to that, Peter Coy. Henley Smith, Dino Kos, Peter, you know, listening to Courtney Donahoe talk about the market's reaction to the Federal Reserve, it's almost as if they're looking at the Fed as it's a stock, saying that the expectations were already baked into the prices of equities, into what bonds were doing, and that when the Fed came out today and said $600 billion, $75 billion a month till maybe June of 2011. It's a kind of, we'll match it, we won't match it. What do you think? I mean, did the market really understand what was happening?
Oh, absolutely. From a trader's viewpoint, I take the old trader's view. It was basically buy the rumor and sell the news. And this rumor has been coming along for a long time. So once it was announced, obviously I think the long market sold off. I think the market was a little disappointed in the structure or the mix of what the Fed is going to be buying, and I think that's what took the 30-year bond down so dramatically after the announcement.
Do you think some of that disappointment, Dino Kos, had to do with the fact that there was a report previously from Goldman Sachs about the 30-year, the very long end of the curve, and the Federal Reserve coming out today and saying, no, we're going to be buying maybe in that mid-range. We're going to be looking at that 7-year, 10-year, around there.
Yeah, well, you know, 2 things. First of all, I mean, rather than a rumor, I mean, they had really been guiding the market towards expecting this program. For 2 months now, they've been talking about what they were likely going to do with quantitative easing, either through speeches and other forms of communication. So the market had largely discounted this move. Now, some people had thought that they might have what's called a shock and awe approach, that they would announce a very, very big number, or that they would buy very long-term assets. And, you know, that was something that they had really not suggested during the last 2 months that they would do. So some people are disappointed, but that's a minority. I think most investors, this is broadly what they were expecting.
Peter Coy, is this going to work? Is this going to actually accomplish the goal of the Federal Reserve, which seems to be to increase employment and maintain some kind of price stability? People, they don't want anyone to hold back from buying, thinking that prices in the future are going to be lower.
But this is not a magic wand. It's not like this one program all by itself is going to turn around the economy. We are in a deep, deep hole here, and if anything, things are getting worse. We've gone from a situation where we had fiscal stimulus and inventory building, accelerating growth, to no longer any fiscal stimulus. In fact, the government comes out as a negative in the GDP, quarter-over-quarter changes. Same with inventories. The Fed cannot correct that with this. All it can do is take the economy in the right direction, and I think directionally this will help. It's going to push up asset prices somewhat, decrease market yields, not just in treasuries, but we hope across a wider range of securities, including private securities. And it'll reduce the value of the dollar, making U.S. goods more competitive in world markets. All by itself, no, it's not going to fix the economy. But I think it's the right thing to do. It's the right direction for the Fed to be going in.
Dino Kos, will it work? I mean, does more easy money really heal what ails the economy?
I agree that directionally this helps. You know, they were very specific in some of their communications that if you increase asset prices, you create something called the wealth effect. So people feel richer, they go out and they spend a little bit more. You're also pushing down long-term assets, so businesses and households can refinance at these lower interest rates and help cash flows and ease that deleveraging process. But, you know, it's not going to take an economy whose underlying growth rate right now is about 2%, say, and increase it to 3.5%, which is what you really need to start bringing down the unemployment rate. So does it help? Yeah. Does it take us back to where we want to be? Not quite.
So, Henley Smith, is it going to work? I mean, it seems as though Peter Coy says it might work. It's the right thing to do. It's not going to solve all our problems. Dino Kos, you kind of say it still is the right thing, but don't expect it to solve everything. What do you think?
Well, I agree. I mean, in some respects, it feels like we're pushing on a string here, and throwing more money at this problem really isn't going to solve it. It's all about, in our opinion, really, It's about creating an environment of confidence in the business world. And I think that's what a lot of people hope happens after this election yesterday, that the government and the administration creates an environment of confidence for business to go out and hire people and start to do the things that we do, as we talked about before. Some businesses are doing very well, some aren't. I agree with the gentleman here that we're in a very big deleveraging process, and all it's going to do, it's going to take time, and that's really our only ally here.
Dino Kos, this idea that the private sector seems to be doing pretty well, right? They're tightening their belts, they're putting cash away, and as Henley said, it seems as though they've got their act together. Is this a situation where the government says, no, 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 we don't want you to hoard all that cash. We don't want you to tighten that belt?
Well, businesses, yes, are doing extremely well. So profits are better, margins are attractive, cash is on the balance sheets. The consumer is still struggling, and small businesses are struggling. So it's not that all of the private sector is in strong shape. The consumer has a lot more deleveraging to do, probably several more years, and that's going to be a drag on the economy. Consumption is 70% of the economy. And so until consumption can get back to, quote, normal, and that's going to be a couple of years, we're probably going to be in this slow motion kind of economy for a while.
Pimm, you say that the government is maybe doing the wrong thing by leveraging up. I think it almost has to leverage up. Somebody's got to be doing the spending in order to maintain aggregate demand in the economy. If the aggregate demand of the private sector goes way down, we would have much, much higher unemployment now if it weren't for somebody spending, and it happens to be the government. And let's think in the broad scheme of things. We are the government. You and I, everybody in this room, everybody in this watching this TV program, we're the government. It's our debt that's being incurred. And so it might be our children who pay it back, but the concept being that if we deleverage here and we leverage up here, on net, the nation as a whole is not leveraging up. The nation as a whole, if anything, is reducing the amount by which it incurs debt to the rest of the world.
But let me push back a little bit, Peter, because it seems as though one of the consequences of doing this is that you have the dollar at 141 against the euro. You've got commodity prices rising, oil at $85 a barrel. And what happens to the value of the debt if the value of the dollar declines? You just devalue the debt. Is that not right, Dino Kos?
Look, I was just in Asia for 10 days, and I can tell you, people in that part of the world are really worried about what's going on here with quantitative easing. They're worried that they're going to be catching a lot of that they're going to be sort of an innocent bystander, if you will, of quantitative easing, that their asset values are going to get inflated, that they're going to be forced to dealing with inflationary pressures that they otherwise would not have. So, they're really worried about what's going on here. And it is showing up in the dollar. So you're right, and this is something that we're going to have to confront. But the Fed's policy right now is to get asset prices higher, push interest rates lower, and even though they won't say this, the dollar gets nudged down as well.
The dollar gets nudged down. Henley Smith,
it has been.
What about mortgage rates? If they continue to go down, but the housing market does not revive, what do they do next? Yeah,
I really don't think it's, in the mortgage world, it's about rate. I really think it's about lending. I think it's all about having banks being able to lend again, making the red tape or the application forms easier, more understood. I think that's what it is. Just driving the rate down, to me, isn't going to do much of anything at this point. I think the rates are as low as they possibly can, and I don't think that driving those rates down are going to do much more in that mortgage market.
So what do you tell clients that come to you and say, Henley, I'm not getting anything by loaning my money to the government. What should I do? Should I be buying bonds? Should I be staying at very short durations? Because eventually, if any of this works, rates will tick up.
Yeah, and that's what we're proposing and telling our clients, is that you should have a short duration piece of your portfolio for the flexibility for if this doesn't work or if inflation does start to pick up dramatically. You should have that in your portfolio to be able to have that flexibility going forward.
Dino Kos, is what the Federal Reserve did today, is it good for banks?
It's a very good question. I'm actually worried that if they lean on the belly of the curve, as it's called, that 4, 5, 6, 7-year sector, and push that curve down, that it's going to flatten the curve, which will pressure bank margins. So I'm actually worried about that. That if this policy stays with us, for too long, that actually bank margins will be under pressure
for an extended period, perhaps.
Well, that's their term, yes, whatever that means.
Well, you were at the Federal Reserve in New York for 2 decades. What does it mean when they say that? Does that mean when things get better?
Exactly. It means when they change their mind, when things are better enough for them to change their view, and what they're doing now, expanding their balance sheet as much as they will, is the exit process will become an issue again. And this is something that we've put aside, so-called exit strategies. It's going to come back on the radar screen. And it's going to be more difficult when the balance sheet is, say, $3 trillion than it was when it was $2 trillion.
Trillion. We're talking trillions here. All right, we're going to. Now, here with his take on the election fallout, we have Jim Lucier, Managing Director for Capital Alpha Partners. Also, we have our Taking Stock think tank. Jim has over 25 years of experience in Washington, where he did everything from lobbying to political strategizing. Jim, you listened to the president's news conference today. Has he changed his view of business, do you believe?
I don't think so. I think that if you listen to what the president said during his conference, we're not really seeing Obama 2.0 yet. We're still in the Obama 1.0 mode. Most of what the president talked about was appearances, process, mistaken perception that people have of his policies, not the substance of the policies themselves. So I don't think we see a lot of change from this press conference yet, nor, frankly, do I think we see a lot of change coming from Speaker Nancy Pelosi, who had a fairly strong statement about continuing in the present course last night, nor from Senate Majority Leader Harry Reid, who also basically pledged full speed ahead on the previous course in his victory speech last night.
Jim, are they going to run smack into the Republicans who are going to take control of the House when Congress reconvenes in January?
That's the big thing on my mind right now. I think that investors need to bear one thing in mind, and that is that failure remains an option. The single biggest thing that needs to get done by the end of the year is the funding of the federal government's budget for the coming fiscal year, and also a decision. Do we extend the tax breaks or not? Most investors, I think the financial markets in general, are very complacent about this. They think that swaggering Republicans who just won a big victory are, in fact, going to extend the Bush tax breaks for at least 1 year, maybe 2. But I think that's not guaranteed. I think the Democrats actually feel pretty good at how well they did last night, especially in the Senate. And so I see a real chance for not a meeting of the mind, but rather a standoff, which will result in no tax cuts being extended and the whole matter really being kicked into next year, at which point tax rates rise on January 1st, and we'll spend the whole first quarter debating whether or not we should lower them again retroactively.
Jim Lucier, give me your best guess for the sort of coming together, the compromise that may take place in Washington. Is it possible that we get Republicans and Democrats actually working together?
Yes, it's going to be, at least in the tax breaks, it will be a 1-year or a 2-year extension of all current tax policies, upper income tax breaks as well as the middle income. And with that, much as the last helicopter leaving Saigon was loaded down with many other people trying to climb aboard, there may be many other tax extenders, tax breaks added on, AMT, estate tax, the so-called extenders bill, renewable energy tax credits. It's going to be one big package, and sometime between Thanksgiving and Christmas, we'll see if Washington can agree on this one big package of tax breaks to extend or not extend. And I'm setting odds at about 60 to 40. 60% they will, 40% they won't.
Peter Coy, Bloomberg Businessweek. What do you make of Jim Lucier's outlook for what might happen not only in 2011, but what happens, let's say, in the next month and a half?
Well, going back to the Fed, Jackson Hole's speech by Ben Bernanke at the end of August, he said the Fed can't do this alone. It can't single-handedly fix the economy. Congress is really not there. What the economy probably needs is more stimulus, but nobody's interested in providing more stimulus now because it was add to the deficit. And now that the House is in Republican hands, any chance of stimulus has gone from being 1% to 0%. putting it back even more on the Fed, which can't do it by itself.
Jim Lucier, does that make sense?
That sure does make sense. We've got divided government two ways. We've got a Republican House and a Democratic Senate, and then we have a Congress and a White House that are on two different planets. So not a lot of legislation is going to get done next year, even though there will be a lot of wrangling over the budget. And the overall theme in wrangling over the budget is going to be cutting spending back to the FY 2008's baseline. Plus, you've got to remember that the presidential cycle starts sometime next fall. So not only do we have a situation of gridlock in two directions, but we also have a very short season next year for passing major legislation. So I do think that on the congressional front, at least, gridlock is going to be the principal thing we have to sit through probably for the next 2 years.
Dino Kos, is this what you're getting from the investors that you talk to? Did they recognize that gridlock seems to be what we're going to get?
I mean, I think a lot of people actually wanted gridlock, and so this was part of the plan. I do just want to add that one thing, if you thinking about the change in Congress, one is that it's going to make the Fed's job a little bit tougher because there's going to be a lot more scrutiny over what they do, especially with the so-called bailouts. The other thing is that they're going to be funding the government in a sense, whether it's directly or indirectly. Their purchases of government securities kind of give you a ready buyer for the Treasury's deficit, but it does set up the stage where it's going to make exiting harder, and it's going to make the Fed's independence fall under question at some point in the next couple of years.
All right, gentlemen, we have to leave it there. I want to thank you very much, Dino Kos, Peter Coy, Henley Smith, and Jim Lucier joining us from Washington.